Let's get right into it. If you think you need to risk your own home, your savings, or sign a personal guarantee to buy investment real estate, you're about to find out how wrong that is.
I mean, really think about that for a second. What if the path everyone takes, the one that puts your family's financial security on the line every single time you do a deal, isn't just the only way? What if it's the wrong way? And this is the trap. It's kind of the default setting for real estate deals, and it's called a personal guarantee. It's that sneaky fine print that legally ties your entire personal life to your business deals. It creates this massive hidden risk that, most people just accept as the cost of doing business. But it's not.
Okay, so look at this. This slide perfectly lays out the two different worlds of financing. Over on the left, you've got your standard recourse loan. If that property deal goes south, the lender can come after everything you own. Your house, your car, your savings, it's all on the table. But on the right, that's a non-recourse loan. If the deal fails, the only thing the lender can take back is the property itself. Your personal life is completely safe. Our goal? It's to live exclusively in that right-hand column.
So how do we get over to that safe side? Well, it all starts by building what I like to call a financial shield. And look, this isn't about finding some shady loophole. It's about using the established legal structure of a business to build a firewall between your investments and your personal life. And the entire legal foundation for that shield is something called the corporate veil. Basically, the law sees a business entity, like an LLC, as its own separate legal person. That means it can own property, it can take on debt, and if it gets sued, your personal assets are shielded. This right here, this is the whole basis for doing this with zero risk. And building this shield is actually pretty straightforward. First up, you form an LLC. This isn't just paperwork, okay? You are literally creating that separate person in the eyes of the law. Second, you get an EIN from the IRS. Think of it as the social security number for your business. And third, and this is a big one, it is absolutely non-negotiable. You open a dedicated business bank account. Mixing your personal and business money is the fastest way to shatter that legal separation you just worked to create.
Okay, so you've done all that. You've got this new business entity, this clean slate, ready to roll. But there's a pretty big problem, right? It has no assets. It has no cash. So how in the world do you fund a down payment on a property?
Well, the answer is a really powerful short-term funding strategy called the 0% capital stack. Most people know it as business credit card stacking. This is how you generate a serious down payment using other people's money without paying a single dime in interest.
The magic number that makes this whole thing work is, of course, zero. We are totally leveraging those 0% introductory APR offers that business credit card companies throw out there to get new customers. For a limited time, you can carry a huge balance without any interest racking up, and that's the entire engine that drives this strategy. Now, this 0% interest ride doesn't last forever. You typically get a window of about 12 to 18 months. That is your timeline. Think of it as a countdown clock. You're racing against that clock to buy a property, fix it up to add value, and then either sell it or refinance it with long-term debt before that promo period runs out. And don't for a second think this is small-time funding. By being strategic and applying for multiple cards at once, you can pull together anywhere from $50,000 to $150,000 in interest-free capital. That's more than enough for a down payment and rehab costs on a lot of solid investment properties. Okay, so let's get into the nitty-gritty. Here's how it actually works. First, you apply for several business credit cards all in one go, usually on the same day. This is called a batch, and it minimizes the hits to your credit report. Now, obviously, you can't just hand a stock of credit cards to a title company, so you have to turn those credit lines into cash. You use a third-party service. Plastic is a popular one. For a small fee, they charge your cards, and then they wire the cash straight to the title company at closing. And just like that, you've turned credit limits into a cash down payment. But you have to remember, this is a bridge, not a destination. That 0% clock is ticking away. The entire goal is to use this short-term interest-free money to get you into the deal, and then immediately work on replacing it with stable, long-term financing.
And this brings us to the end game. This is the ultimate goal, getting that long-term financing that is based entirely on the property's ability to make money and has absolutely nothing to do with your personal paycheck.
The key that unlocks this world is the DSCR loan. DSCR stands for Debt Service Coverage Ratio, which sounds complicated, but it's not. It all boils down to one simple question. Does the rent coming in from the property cover the mortgage and expenses? If the answer is yes, and that ratio is strong enough, lenders usually want to see 1.25 or higher, you get the loan. They never even ask to see your W-2s or tax returns.
This quote from McGowan Mortgages just nails it. It perfectly captures the massive shift in thinking. The lenders are underwriting the asset, not you. The property itself is basically the applicant. For anyone who's self-employed or just wants to scale beyond a few properties, this is an absolute game changer.
And this chart just makes it crystal clear. Let's put them head to head. A conventional loan is all about you, your W-2s, your personal debt to income. A DSCR loan, it's all about the property's cash flow. With conventional loans, you have to buy it in your own name and you hit a hard ceiling, usually around 10 properties. DSCR loans, on the other hand, are designed for LLCs and have pretty much unlimited scalability. They are literally built for serious investors.
So, you did it. You've got a property with zero personal risk. But that protection, that shield, it's not invincible. You have to maintain it. And there are a few critical mistakes that can absolutely shatter that financial shield you worked so hard to build. A court can decide to pierce the corporate veil, which makes you personally liable all over again. This usually happens when you stop treating the business like a separate entity. The number one offense, commingling funds. That means using your business account for groceries or your personal account for property repairs. You also got to keep clean records and obviously avoid any kind of fraud, which can trigger these things called bad boy carve-outs that make you personally liable even on a non-recourse loan.
So the bottom line is this. Your protection isn't a one-time setup. It's an ongoing practice. The strength of that corporate veil is directly tied to how disciplined you are in keeping a strict financial wall between you and your business.
And that brings us to the final question. When you take away that fear of losing everything you've ever worked for, when your personal risk is effectively zero, what does that free you up to do? What kind of portfolio, what kind of future suddenly becomes possible?